When volatility increases, how do you adapt your trading strategy and risk management?
So, depending on what your approach to the markets is, rising volatility can be approached in one of two ways generally. For the active trader, so the smaller retail trader, self-directed trader, and certain market participants where they're trying to get into a market that is somewhat inefficient. High risk, high volatility is inefficient.
Yeah.
And certain trade categories are looking for that inefficiency because it means that there's an opportunity to either arbitrage or take advantage of larger swings in price action if you have a strategy that needs that movement over a shorter period of time. So if you are of that type, you are seeking out higher volatility. Now, volatility can be different according to different markets. So if I were comparing something like the equity market to the sovereign debt market, equities would be significantly more volatile than sovereign debt. Or if I were looking at FX volatility versus emerging market asset volatility. Emerging markets are much more volatile than especially liquid FX, like a pair like the Euro USD. So if I saw a rising volatility relative to that market itself, so let's say I was sticking with one asset, the S&P 500. As the S&P 500's volatility rises, either the VIX is rising from 15 to 30, or if I see the average true range on the S&P 500 rise from 5% to 10%, then if I were a trader looking for that volatility, that would cue to me a need to go and look to employ a strategy to take advantage of that volatility, that price action. On the flip side, if I were, let's say, an investor or a hedger or somebody that's actually looking to these assets as a means to sell a good, a commodity, for example, then I'm going to want to avoid that volatility. Now, while it does make sense for everybody to always have some kind of security to their exposure in any market, and that can be a stop loss already set because you have a clear threshold, or that can be a derivative or something along those lines. A lot of traders in particular and large investors will avoid having any of these until they actually think that they are necessary. Funny thing is, when volatility is really low and the markets are stretched, there's a tendency for no interest or a reduction in exposure to those hedges because they don't want to have those eat into the cost of their capital gains or their yield in otherwise quiet times. It's kind of a dichotomy, or it gets to the extreme. But if you see a rise in volatility, the need for a hedge, especially if you can't easily get in and out of a market, the underlying will rise. So as you see that volatility rise, if you're in this category, you want to seek out either a hedge, whatever that can represent, an offsetting position, a derivative, or you might want to just be a little bit more proactive. You might have a stop that, let's say, is 300 points away. You might want to move it 100 points away because volatility is non-directional. So if just volatility picks up, you might want to move that stop closer just to be safe.